not slowly, not over weeks of bad headlines. In one sentence, spoken by a regulator, to a room full of employees who had shown up to work that morning like it was any other day. Across the Atlantic, in New York, it was 10:30 in the morning. Bankers at Chase Manhattan and half a dozen other institutions had already done their part. Hours earlier, they'd wired millions of deutschmarks to a small German bank called Herstatt, expecting US dollars to come back the other way later that same day. Standard foreign exchange trade. They'd done thousands of them. Except this time, the dollars never came. Because by the time New York's markets opened, Herstatt didn't exist anymore. The man behind the bank was Herstatt, a Cologne banker who'd built a modest merchant bank into a serious player in currency trading through the late 1960s and early 70s. And the early 70s were a wild time to be trading currency. The world had just abandoned fixed exchange rates. The US dollar was swinging wildly against every major currency on Earth. For a bank willing to bet big on which way the dollar would move, there was real money to be made. Herstatt's traders bet big, bigger than anyone at the bank should have allowed. Internally, the bank had a rule. No trader could risk more than 25 million Deutschmarks at a time. It was ignored completely. Positions piled up far beyond that limit, all riding on guesses about where the dollar was headed next. For a while, the bets didn't matter because nobody outside the trading floor was checking. Then the dollar moved the wrong way, and it kept moving the wrong way. By June of 1974, Herstatt had racked up losses of 470 million Deutschmarks. Its entire capital base was 44 million. The bank had lost more than 10 times what it actually owned. That's the part regulators eventually understood. Here's the part that made Herstatt famous. German banking supervisors had already made the decision. Herstatt was insolvent, and its license would be pulled. But the timing of when they pulled the trigger is what turned a routine bank failure into a global financial event that's still taught in economics classes 50 years later. They closed Herstatt at 3:30 p.m. Frankfurt time. After German banks had already sent their side of the day's currency trades, the Deutschmarks, to Herstatt's accounts. But before Herstatt had sent back what it owed on the other side of those same trades, US dollars, due to land in New York, where the trading day was just getting started. Picture it from the American side. You're a correspondent bank in New York. You did your job. You paid out Deutschmarks that morning in good faith for dollars you were owed hours later. Then word arrives from Germany. The bank on the other end of your trade no longer exists. There is no dollar payment coming. There's just a hole where your money used to be. Multiply that across every bank that had a trade open with Herstatt that day, and you get chaos. The main US clearing system for interbank payments, CHIPS, had to shut down entirely for 24 hours, while banks tried to figure out who owed what to whom, and who was now exposed to a loss they hadn't priced in that morning. The total hit to Herstatt's counterparties has been estimated at around $328 million in 1974 money. Adjusted for inflation, that's roughly $2 billion in today's terms. Vanishing not because of a market crash, not because of fraud in the traditional sense, but because of 8 hours and one time zone. That's the twist that makes this story different from almost every other collapse on this channel. Herstatt wasn't Madoff. Nobody was running a fake business on paper. The bank had a real balance sheet, real clients, a real trading desk. It just took on catastrophic risk with almost no capital to absorb a bad outcome, and then failed at the single worst possible moment in the global clock, a moment nobody had ever designed the banking system to survive. Because up until that afternoon, banks around the world assumed that if you paid your side of a currency trade, the other side was basically guaranteed to show up. Herstatt proved that assumption was false. If your counterparty fails between your payment and theirs, you can lose the entire principal, not some small credit spread, the whole amount. That gap now has a name. Bankers still call it Herstatt risk. The risk that you pay first, and your counterparty simply isn't there anymore when it's their turn to pay you back. The fallout reshaped how the entire world moves money across borders. Just months after the collapse, the G10 central banks met in Basel and created what's now called the Basel Committee on Banking Supervision, the body that still writes the global rulebook for bank capital and risk today. And nearly 3 decades later, in 2002, the financial industry finally built a system called CLS Bank, designed specifically so that both sides of a currency trade settle at the exact same instant, eliminating the exact gap that swallowed Herstatt's counterparties in 1974. A bank that ranked 35th in Germany, nowhere near the biggest player in the room, came within a bad afternoon of dragging the global payment system down with it. Not through a massive fraud, just leverage, bad timing, and a regulator's decision made 8 hours too early for the other side of the world to see it coming. If you want to see what happens when a bank gambles with money it never had permission to risk, go watch our video on continental Illinois. A bank so reckless it needed the largest bailout in American history up to that point, and it almost didn't get one.